You're listening to the Practical Wealth Show with Curtis May.
All right. Hey, welcome to another episode of the Practical Wealth Show, where we talk about all things of creating wealth outside of Wall Street, taking control of your financial future and not giving your money to some fund manager 1,000 miles away that you never met and hope the market goes up. We don't think that's a good plan. Okay. So so keeping in that theme, in our principles, principle 5 in the 5 principles of personal finance is velocity of money, okay, and generating cash flow. So we want to talk to you about a way to do that for some of y'all busy people and you've got money, you want something to do with it where you can generate a little bit of velocity and you can focus on your thing. Well, today I have for you Mr. Kent Ritter. So let me just give you a head. So the topic is take control of your wealth through real estate investing. Among other things where I know our conversation is going to go. But Ken is the CEO of Hudson Investing. He's on a mission to create modern, affordable housing for America's workforce while empowering others to take control of their financial future through real estate investing. So since 2019, Kent has led the acquisition of, get this, 440 units since 2019, guys, and deployed over $6 million of investor capital into cash flow and real estate through his firm, Hudson Investing. So, and we'll give you these in the show notes, but I just want to tell a little about him. Kent serves as a real estate leader through education. He's got a podcast, Ritter on Real Estate. He's got a local networking event, invests in Indianapolis multifamily investment meetup, KentRitter.com, right? And so Kent, welcome to the Practical Wealth Show.
Thanks, Curtis. Appreciate you having me on today. Excited to dig into some of my favorite topics, but just building velocity in your money through cash flow. Love that.
All about velocity. And it's funny because when you look at, I was on a call one time with this guy that one of the insurance companies I work with, managed their 30 plus $1 billion. And he didn't do any of the stuff literally did the complete opposite of what all the personal finance gurus do. He didn't buy and hold, he ain't worried about compound interest, getting out of debt. They don't do any of that stuff. Right. So tell them what I didn't tell them. If I left anything out that you want to share, and then tell me why and how we need to take control of our future through real estate investing. Why is that your favorite asset class?
Yeah, no, absolutely. So I can give you a quick background on who I am. So I started my career out of college as a management consultant. And what a management consultant does is really we flew around the country and helped big companies solve big problems. That's essentially what we were paid for. Nobody was calling us when things were going well. So I got very good at diagnosing issues within a business, seeing what works and what doesn't work in a business, and just seeing that over and over again for a number of years, 12 years in that career. Just got very good at knowing within any business, what are the levers you pull, right? What are the things that really move the needle? How do you affect large change, right? And how do you communicate well to get people on your side and moving in the right direction and aligned with your vision? Mm-hmm. And so for the last 5 years of that career, a few partners and I left, and we actually started our own consulting firm. And so that was from about 2010 to 2015. At the end of 2015, we sold that business. We had grown it to 95 employees and 30 million in annual revenue at that point. Decided it was the right time to exit. And that was really what kicked off my real estate career, because I had money from exiting that business. I knew I didn't want to put it all into the stock market, right? I didn't want to have all my eggs in one basket, but I didn't know where else to put it, right? Yeah. And so that I started just digging into alternative investments and digging in and researching and listening to as many podcasts and all the books I could absorb and went through, kind of a series of different investment types, evaluating things. And real estate was the one for me that really checked the boxes. It, had a cash flow component, right? It has a strong appreciation component. There's significant tax savings that can be had. And it's a tangible asset, something you can see, touch, feel, not a stock or something that is kind of out there in the market and you have no control of, and you can wake up one day and, it's down 30% because something happened across the world that you had no control of.
Right.
Right. And so for all those reasons and just the non-correlation with stocks, right? That they're not correlative. Stocks go down doesn't mean real estate's going to go down. So for all that, I felt like real estate was the place to diversify, and felt that I could, really just begin to passively invest with others because, I didn't know. I knew there was a lot I didn't know. I knew there was probably even more that I didn't know at that point. So I started investing with others, and I started passively investing with different syndicators, different deal sponsors. 2016, I went out and invested in 10 different deals with a whole host of different sponsors, and really was using that not only to generate income for myself with the cash flow, but also as a learning experience, as a way to really get behind the curtain in these deals, see what's going on, ask the questions, and really continue to just gain an understanding and knowledge in this space, knowing that eventually I wanted to be doing this on my own. I wanted to be out acquiring deals. And so went through a few mentorship programs, a whole host of conferences, probably 10, 12 a year. Fast forward to 2019, I partner with a group, and we go out and we acquire what's my first active syndication. It was 250 units down in Atlanta, Georgia. Acquired that in October of 2019, and actually we're here at the first day of July. So a couple of weeks ago, we just closed on that deal. It's the first deal I've had come full cycle all the way around, from buying, improving, and then selling. And we hit a home run for our investors. We planned to hold that for 5 years. We held it for 21 months, and we sold it because we could get the returns that we told them we'd get them in 5 years in less than 2 years. And so it was a great first deal, and happy to have that one closed up. That was a big milestone for the company. So in 2020, we continued to go and invest, acquired several more properties in Indiana, Ohio, and Kentucky, and continuing into 2021 with another property, and we've got a few under contract right now. And that's really, so it really just kind of escalated from there. I just fell in love with real estate. I love the wealth creating power that it affords. And it's been life-changing for me. It's not only from a financial standpoint, but just from a personal development standpoint on really the amount of personal growth I've gone through of kind of looking inward, and crushing a lot of the limiting beliefs that I had, to be able to think that I can go out and I can acquire these big apartment deals, and I can bring other people's money in, and I can be a steward of their money, and I can be successful in that. Right. Yeah. And so it's been just an incredible journey over the past few years, and I'm just blessed to be where I'm at now and here talking with you today.
Yeah. You're blessed to be here talking to me today. No, just kidding. Yeah. So I want to point out a couple of points, because one of the things that we teach I want them to hear this in your story. All right. Yeah. So just, one, what we teach at Practical Wealth is your number one asset is you. Right. And so you have to invest in your mindset, your skill set, and your network. Right. And the other thing that we teach is that investing is not necessarily about buying something. It's about becoming something. Right. So I would say you have become an expert. You've become a leader. But how did you get there? Well, you invest in your mindset, your skill set, 10, 12 conferences a year. Okay. He had some capital, so he didn't just give his money and send me a check. He wanted to get on the inside of deals. So you got to learn some stuff. See, most people think, they just want what I call the easy button. And there's a place for that, but investors want control. You want non-correlated assets. You don't want somebody, blowing up something on the other side of the world to make your portfolio drop 30%. So that's right. There you unpack a lot there. So yeah, and that's and leverage, right? Because you don't have to use your money.
Yeah,
and get me excited now. Inflation makes you more money.
That's right. That's right. That's one of the best parts of real estate is, with inflation, you have asset appreciation, and you also have rent growth. I mean, rents really grow with inflation over time. So yeah, I mean, yeah, well, like you said, to go back to kind of the beginning of that, you talked about mindset and that's right. I mean, my mindset, even when I was an entrepreneur, even when I was running, my own consulting business, my mindset was, it just wasn't where it's at today. I was successful, right? We had a ton of success in that business, and that was good. But there was still a kind of this idea of I needed to have this partnership group around me. I needed to have still kind of what I consider kind of a safety net, and it was really getting out of that and really being able to really put myself out on my own, even in starting my own podcast, right? That was a huge mindset shift for me to have to say, I think people talk about that imposter complex, right? Of like, am I the expert? What do I have to share? Will people listen to me? I went through all those things when I set out to start my podcast. And that's why I started about a year later than I really wanted to. And it was all those doubts. It was, well, who's going to listen to me? What do I have to share? How am I an expert? I've only been doing this for about 5 years at the time. And there's people that have been doing this for 20, 30 years. But what I realized is that, the amount, what I learned in that amount of time through very intentional, just waking up at 5 a.m., studying real estate for a couple hours before I started my day job, doing this, doing the same thing at night, and doing that for a number of years, kind of working 2 jobs, allowed me to put in the time, to really become that expert in that short period of time. The other huge value have been the mentors that I've had in my life that have allowed me to exponentially grow by just completely leapfrogging normal steps that people would take, such as most people go into real estate, they start buying single family homes. You become a landlord and they get kind of stuck because you can't scale that. Well, I was able to skip that through great mentorship, saying, no, don't focus on that, get into multifamily. Okay, well, great. Well, multifamily, okay, I'm gonna go out and buy a multifamily property. Again, another mentor stepped in and said, don't go buy your own property. You need to learn about syndication. You need to learn about how you can actually pool money together for yourself and others and go buy bigger, better assets than you could on your own. And in doing that, you avoid having all your eggs in one basket again. You can diversify and you can continue to grow, and you can actually turn that into a business. And when I heard that really excited me. Like the light bulbs all went off. I was like, I can't believe I didn't know about this years.
You're exciting me. I'm like, okay, I don't want to really do multifamily. I really don't want to do single family. I want scale.
Because
I'm not getting
there's so much scale, right? And the scale, there's so much scale. There's so many advantages from the type of debt you can get. There's just a lot of advantages in multifamily.
So talk about that. Talk about the.
But multifamily was the place that really checked those boxes for me.
Yeah. So talk about the benefits of buying. I guess, would you consider yourself, you buy small multifamily? Tell me what your ideal target of properties you look for and why.
Absolutely. So small is relative, right? I consider small like anything under 200 units. And so
that is relative.
So it's all relative. And really, because that 200 unit and up level is really where the large institutions play. The PE firms, the REITs, the insurance companies, other groups, they focus on acquiring 200 plus units because they're so large and they have to deploy so much capital that they have to have that scale. Right. So what I found is if you go below that, say my sweet spot's about 30 to 150 units. And what I found is it's really kind of a no man's land, because once you get up to about 30 units, that's usually too big for kind of a mom and pop type to manage on their own and really be effective and really get all the value out of that property, right? So on that end, focus on buying from a lot of folks who are maybe overextended, right? Or just don't have the desire to do it anymore. It's become too much of a job. It's a grind. They don't have the capital to keep the property up to the condition it should be kept up at, right? So there's kind of that side of it. And then on the other side, Again, just staying under the radar of all these big players out there that are all competing for the same properties,
Yeah.
and kind of finding this no man's land, right? Where just reducing the competition allows me to buy at a better value, right? You make your money when you buy in real estate, as the old quote goes.
Mm-hmm.
And so if you're in a situation where, and it's the same thing from the markets I choose. That's why I invest in the Midwest. One, I'm in Indianapolis. I have hyper localized knowledge of the area. I have great relationships in the area. And also, the Midwest just isn't the sexiest place to invest. And
Right.
that's okay with me. I love that about it because, again, it keeps the competition out, right?
Right.
Everybody else is chasing deals in Dallas or Phoenix or Atlanta or wherever else, and they're all competing. And it's not uncommon in those markets to have 20 to 30 people all bidding on the same property.
Mm-hmm.
And in that environment, you cannot buy at a good value, right? So by focusing on the Midwest and focusing on mid to smaller properties that are kind of in this tier under where everybody else is looking, I'm able to, again, take out the competition. And because of that, I'm able to find these properties that are great values, better values than things that have just gone to market, buy directly from sellers, buy through close broker relationships, and create a ton of value for my investors that wouldn't be possible if I was just trying to say, I'm going to go enter Dallas and I'm going to pay top dollar for a deal
Right.
just to get in, right? That's not the strategy. If everybody's going left, I want to be going right.
Right. That's my basic philosophy about life. The majority is usually wrong. So it seems like this would have been helpful. Your management consulting. So you said one thing as you know, looking at business, which this is a business, you were able to, you train your mind to see problems that you could fix. Is that kind of what you do or part of your analysis?
Exactly right. I mean, that's essentially how you make money in real estate. You solve problems,
Mm-hmm.
you know? And so if you can see a problem and you have the vision to see through the problem to the solution,
Yeah.
you can make a lot of money. And that's really about what I do. What I do is, what I'm really good at is seeing the value in these properties that are, they're old, maybe they're run down, they're older, they haven't been kept up, but being able to see what they could become and have that
Right.
vision to do that.
Right.
And then really the secret sauce then is the ability to align people to that vision and get multiple groups, construction, property management, all whole host of lenders, investors, whole host of people, all understand that vision, all getting behind it and all moving in the same direction to achieve that goal. And in doing that, we're able to create, great cash flow, but then a ton of appreciation that we're forcing, right? Yeah. I mean, that's a great concept, right? And that's one of the reasons that I like commercial real estate over residential is that idea of forced appreciation.
Yeah.
Because, residential real estate is valued through a market survey, right? So your house is worth, this value is relative to what the places around you sold for, the house next door, the house down the street, right?
Right.
Commercial real estate is valued by the income. So as we come in and we affect change and we increase the revenue, we better manage it, we decrease expenses, we're increasing the income for the property. And as we increase the income, we are directly impacting the value. There's a concept in real estate called a cap rate. Right. And what a cap rate really is like the inverse of the multiple on that property. So the lower the cap rate, the more the property is worth, right? And so the easy math is it's just the income divided by that cap rate is the value of the property. Okay. So as we increase that income, if the cap rate, let's just use an example. If the cap rate is a 5 cap, which is very standard in the market today, 5 cap, and we have, doesn't matter. So with a 5 cap, for every dollar that we're increasing income, we're creating $20 in value on that property. So you're taking, that dollar that you increased and dividing that by 5%, and that's 20. So, for every dollar, we're creating $20 in value. And so you can see how very quickly small changes
Yeah.
can create massive value because you're multiplying it all by 20.
What are some of the unique ways you increase profits in your multifamily with, without raising rents? Because I've never heard that concept before. Let's talk about that.
So I think it's important that your strategy aligns with the market and the time in the market. And, where we are, rents have been increasing year over year for a long time. There's this idea of affordability, and there's a concept of being rent burdened. And what rent burdened means is if you're spending more than 30% of your income on your rent, then that the idea that you're considered rent burdened, then the idea is that's unsustainable, and that's defined by HUD, housing and urban development. That's their definition. If you're spending more than 30% of your income on rent, that's too much. And so what we look at is, one, when we look to buy, that's a prime metric we look at, is what is the income in the area relative to the rent. Is the rent affordable? I mean, I like to buy teens with that rent to income ratio that are in, or properties that are in like the high teens, the low 20s, nice cushion up to 30, right? Because that means we can come in and we can implement our changes. And whether we're raising rent or adding in different revenue streams, there's a nice cushion there that remains relatively affordable for folks. And that's really important because that's how you make sure that your property stays full and that you can compete. But so this idea of affordability, and that's why you can't just raise rents. I think that's where people get in trouble, is when they don't take into account the demographics of their area and they say, oh, I can come in and I should be able to raise rent $200. Well, can the people that are actually going to live in your apartment afford that? Right. I think that's something that people need to look at. So other ways that we've found to create value are in like income generating amenities. One of my favorites is actually becoming the cable and internet service provider for the residents. And so we've implemented a strategy on several of our properties where we've implemented high-speed internet, fiber internet to the property. We actually pay the upfront capital expense to do that, to run, bore the holes and run the wires and get it all wired in. And then it allows us to offer, so the units are already wired for internet. Somebody moves in, we flip a switch, their internet's live, their TV's live. Wow. They're not having to deal with Comcast or Spectrum or whoever else. And I love it because we're able to offer a better product, higher, because it's fiber optic, higher speeds, stable internet. And we're able to offer at a lower price than what the cable companies are. And we do a market survey to know that. We come in and we'll knock $10 to $15 off their cheapest package, even though we're giving them better value, better speeds. And in doing that, we're not creating an additional financial burden for the resident. They're already paying somebody for internet and TV, right? We're just shifting it to pay us, and we're putting that revenue into the property. And it's a win-win because the resident's getting better service, lower price. It's a win-win for us because we're getting that revenue now. And so that's one of my favorites that we've been implementing. And the residents love it because they're getting better quality. They don't have to ever deal with the cable company. And, it's been a huge game changer on some of our properties. So that's one of my favorites. Yeah. Others that we've implemented are like renting washers and dryers. So we have properties that have washer dryer hookups. We'll actually go and purchase brand new washer dryers, and then we rent them to the residents, so that they can have a washer dryer in there. They don't have to rent from a rent to own or somewhere else, right? They get a brand new unit. Nobody's ever used it. And then again, just renting that back to them, as an additional service.
That's brilliant. So that's kind of like, so this integrates with what you call like into affordable housing. Like, I guess your mission is how to socially impactful with your, is what you're trying to do. And that's how you do that, by looking at the demographics of the rent and staying within that and giving them value adds within what.
That's right. I mean, at the end of the day, I do really, I mean, I know like, impact investing is a big buzzword, right? And I didn't get into this because of that. I got into this, to be honest, because you can create a ton of wealth, and I could create a ton of wealth, not just for me, but for everybody around me. And that's what really I was passionate about.
And guess what? There's nothing wrong with that. See, you all never have to apologize for making money on my show, okay? Because I'm a capitalist, right? I'm a flaming capitalist. And because if you made money, see, because people, I'm going to a 30-second rant.
Go for it.
The money follows value. Okay. And so you want to make more money. You got to figure out how can you serve more people, create more value in the marketplace, and money's a result. So Kent is creating value for his residents, his investors. And so guess what? You're supposed to make money. So, don't, if y'all listen to this, don't apologize for making money or wanting to make more money. There's nothing evil about that because money follows value. All right, so my rant is over.
And you're absolutely right. It's like it's about what you do with it, once you have it, right? And that's so I got into real estate. It's a great way to create wealth. What I realized was as I started touring these properties, I mean, it really hit me that the situations that some people live in day to day, touring these apartments and seeing the just the rundown buildings and just the poor living conditions that people live in, and I didn't really understand that until I really started getting into these B and C class properties and touring and meeting these people. And so what I mean by that social impact of it is what I realized and has really become something I'm very passionate about is, I mean, everybody deserves to have safe, clean, like affordable, like attainable housing, right? And so that's something that we are able to create because we're coming in and we're buying properties that are often, they've got deferred maintenance, there's leaks, maybe there's issues. They've got, 20-year-old, 30-year-old appliances. They're dirty. They haven't been upkept. And we're able to come in and we're able to, we fix up the properties, right? So we're putting in, new floors, painting, new appliances, new lighting, whatever they need. We're adding additional amenities to the property, right? We're adding things, maybe it's a playground, right? For the kids in the neighborhood to be able to play in. Maybe it's a gazebo with grill stations. Maybe it's a community garden, right? There's different things that we do. We're adding LED lighting to the property to increase the safety of the property, right? Because now it's lit, right? So this idea of creating clean, safe, affordable housing and the title I use is for America's workforce because it's people that typically make as a family, 40 to 60,000 a year, right? Many of the people are renters by necessity, not by choice. A lot of them are lifetime renters. But those people deserve, just like everybody else, to have a clean, safe place to live. And that's something that we're able to come in and we're able to bring. The win-win is when we're able to do that and still maintain under that 30% mark we talked about earlier. So it's still, even though we're giving them new units and better amenities and a cleaner, safer property, we've got to raise rent or prices a little bit to help pay for all that, right? And to get the return to the investors who are giving them money to be able to make those changes. But if you can do that and maintain that level of affordability under that 30% mark, it's a win-win for everybody, right? And so those are the situations that I'm really trying to create through our investments.
Right. So tell them a little about, as we wind down, about what you do for if this is appropriate, for the people that invest with you, who you're looking for, how you serve them. And then you tell them how to reach out to you.
Yeah, absolutely. So people typically invest with me for a couple of reasons. One is they want cash flow and they either want to get out of their W-2, so they want to replace their current income, or maybe they just want a plan B because they're smart enough to realize that quote unquote stable job with that corporation isn't so safe, right? People get laid off every day. So you got a
Right.
plan B. Others are folks at the end where they are, they're retired and they're just looking to they know their 401k is not going to sustain them. And so they're looking to create, again, additional passive income, right? So those are the income folks. There's other people that maybe they like their job. I have a lot of doctors, attorneys, CPAs, folks that, are really passionate about their careers, but they want to keep their money working for them. They don't want it just sitting in a bank account, and they want to continue to create wealth, and they want that to continue to compound. So they're looking for wealth creation. So they're looking for the ability to come in and double their money every 5 years, right? Which is our goal, not our guarantee, but our goal.
Right.
And they want that accumulation. And then there's others, a lot of folks who are entrepreneurs, who own businesses, have other income streams, who are looking to offset some of those taxes. And real estate is a great way to offset some of the taxes from your businesses or your other investments. And so those are the reasons why people invest.
Yeah.
Typically, I find.
Yeah.
Now what we do is what we're doing is we're finding a property, right, where we know we can come in and create value. We're getting debt from the property, typically 70 to 75% leverage, right, which compounds your returns.
Right.
But then for that 25 to 30% of the down payment, and then to pay for the improvements, we're raising equity from folks. And so I say you get to invest alongside me because I'm putting my money in each of these deals. You're putting your money in right alongside me. And then I'm running the deal, and my team are running the deal, and making sure that over a 3 to 5 year period, we're implementing the improvements. We're running that property as best we can. And then we're exiting it. And then we're rolling into the next one. And the process continues.
That is perfect. And I'm assuming they get monthly and quarterly cash flow, and then they get
That's right. Yeah, there's a regular cash flow component, either quarterly or monthly. It can be different depending on the dynamics of the deal, but regular cash flow. And you're getting about 30 to 40% of your total return through that monthly cash flow. You're getting your share of the profits.
Yeah.
At the same time, you're getting your share of the depreciation, right? Which is coming back on your K1. So you're showing a loss during that period. And so it offsets, the taxes from those gains. And then at the end, you're getting about 60 to 70% of your return through the appreciation from going back to what we talked about at the beginning of that forced appreciation, right? We're forcing that appreciation. We're selling at a higher value. And so you're getting that big chunk of money at the end. And like I said, my goal is to double your money in 5 years. And that's kind of how we look at every investment. And even though we may be holding for 3, we still kind of extrapolate that out. And that's kind of that trigger I look for when I'm looking to make an investment.
Yeah, I love it. I mean, one of the things that we teach velocity is cash flow. So you can put your money, and if you're getting cash flow, your risk goes down because you're getting back your money. Plus, you can't eat equity, right? Equity don't allow you to go to the beach and stay there for a month. You know what I mean? You need cash flow. So I always go by the Robert Kiyosaki definition of an asset is something that puts money in your pocket every month without your labor. That's right. And so buy assets. Middle income people buy liabilities. Rich people buy assets. That's right. And so one of the main things I tell our clients is I want to make sure you're liquid, you understand how to read your numbers, and you understand the difference between an asset and a liability, and buy assets, and get yourself out the rat race in a decade or less. And so what Kent is giving you a vehicle that you want to research that might be a good fit for you to look at that. You've got to, make your own definitions, but your own due diligence. He's got a good scope of work, 440 units in 2 years. Okay. And through COVID. So you want to take a look at that. So Ken, how can they follow what you're doing? Where would you like them to go to, follow what you're doing and find out a little more about you, your show, and all that good stuff?
Yeah, Curtis, I appreciate that. So the easiest place is go to kentritter.com. That's my home base. You can access my blog, my podcast from there. You can learn more about me. We've got some resources for passive investors, like commonly asked questions, a terminology sheet, like definitions, which is just a ton of jargon in this space. So it's a really good place to start, just understanding all the things that you're reading in these investment summaries. So you can go there. The next thing I'd say is if you want to learn how to be a multifamily investor and how to make better investing decisions, it's my podcast, Ritter on Real Estate. The tagline is passively invest like a pro. And that's exactly what we're doing. We're interviewing the pros to give you those tips so that you can be a better investor.
I love it. Hey, so guys, so we're going to put all of that in the show notes. So make sure, that you reach out to Kent and listen to his podcast. Cause a lot of your, if you're, let's say you're more active, well, now you get to listen in on, how the pros are doing it. So if you're trying to be a syndicator or you're even, you have a few, multifamilies or single families, all of it's it's a business. So business is business. You got to learn how to run your business better. And maybe you might get the bug and you want to scale up, to the next level. And because it's just a matter of zeros. Right. And so that's all good. So Kent, thank you so much. This was an awesome interview. Thank you so much for being a guest on the Practical Wealth Show.
Absolutely. Thanks, Curtis. I had a blast. Hope I could help educate some folks out there and turn some folks on to apartment investing. Like I said, it's had a monumental impact in my life. And I truly believe it is the best way, at least for me, to create wealth. And so I've fallen in love with it. And now I love taking people along for the ride and seeing the impact it has on their lives. So it's a passion project for me for sure.
That's good stuff. I want to be like you when I grow up.
Thank you, sir, for having me on.
All right. Yes, my pleasure. So go out there, follow him. If you like this show, leave us a review on podcast and, feel free to email me. Go to practicalwealthshow.com or, just wherever you listen to this stuff. And, you can email me and give me show ideas or questions that you have and reach directly out to Kent when the show comes out. Guys, thank you. Go out there and make it a fantastic day.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted